As you can see, this halving chart is on the right. It has been measured mathematically. And yes, we did come up with ideas for Bitcoin with miners. The monetary policy was written in 5 lines of code, to be exact. I didn't know that until we talked about Bitcoin. Such a beautiful, simple, and clear design. On the other hand, look at this. Okay, this is M2 growth, and it shows the percent change over 4 years. It's spread out, as you can see. From what you can see, it went up to double digits in the 1960s and 1970s, and it stayed there. Right now, things are very interesting because of the uncertainty of money around the world. We reach a steady state of about 0% year-over-year growth by the end of the year. That's from 1 year to the next. We've only seen this line drop to 2% to 3% once, as you can see. It happened in the 1990s, and then everything went crazy around the world. In a recent show, Cathie Wood, the CEO and CIO of ARK Invest, along with Yandra, the director of digital assets at ARK Invest, talked about what Bitcoin events mean in a world where monetary policies are unstable. Each halving event lowers Bitcoin's issue rate by 50%. This keeps the inflation rate of the cryptocurrency stable until the next halving year. Central banks' monetary policies, on the other hand, usually involve making more money available during times of monetary loosening, which could have effects that can't be undone. Based on their research, Bitcoin is likely to continue to grow and appreciate, while standard finance is on the verge of collapsing. Cathie is worried about the U.S. Federal Reserve's plan to keep interest rates high until inflation is under control. She thinks this is a big mistake that could make market and economic conditions worse, like they were during past recessions. She wants steps to be taken right away to stop another global financial crisis. In parts of the movie, Cathie talks about Bitcoin's mathematically sound monetary policy, the instability of the world's money system, and how the cryptocurrency industry is the best way to protect against this widespread instability. From March to March 4 years ago. What was the annual rate of growth in money? You can see the black dashed line, which is the last fact point here. That rate is about 8%. In fact, it's probably more like 6%. This chart shows a lot of information. But look at how much M2 has grown over the past 4 years. It's spread out, as you can see. You can see that it went up to tens in the 1960s and 1970s. And by the late 1970s and early 1980s, inflation was over 10%. It took a while to get there. It looked like it was really sticking. After Chairman Volcker took over, I believe it was in 1979, he said, "We need to get this thing under control," and he began to cut off the flow of money. And that trend stayed strong until the mid-1990s. Then, in the mid-1990s, it's very interesting because it's kind of like now. In the mid-1990s, currencies all over the world lost value one after the other. Because our money is the world's reserve asset, our monetary strategy spread all over the world, and Mexico was the first country to lose value. It was a big one. We were dealing with Mexican stocks, so I remember it very well. Finally, after a few years, there was the Asian domino effect. I believe the Thai baht lost value in 1997. Then the value of the rest of Asia's currencies went down. In 1998, Russia let us down. Then long-term capital started to fail. The system is affected by monetary policy. And because it's so unexpected, people do a lot of bad things. So what do we have now? We can see what took place because of COVID. That made M2 grow by 12% a year over the last 4 years. Then there was a very sharp slowdown. In the 1960s and 1970s, there was a sort of acceleration, at least in the sense of a trend and a stability near double digits. But this time, money was thrown at the system to keep it from going into a full-on depression. And if we can keep year-over-year growth at around 0% by the end of the year, this line will drop toward 2% to 3%, which is something we've only seen once. It was the 1990s. After that, everything went crazy around the world. It's been longer since the last time the Fed raised interest rates than it was since the last time it put them down. We're now above normal, as you can see. This has happened 3 times in a row when prices were higher than they are now. Each time was a sign of the global financial crisis of 2008 to 2009. It was an early sign of the tech and telecom bust in 1997 and 1998. And from 1969 to 1970, it was a sign of a coming decline. Right now, things are very interesting because of the uncertainty of money around the world. Because of this, I talked to Yasin a lot about these drops in value. Additionally, in developing nations, anyone with an internet connection can now pretty much set up or buy an insurance policy in the form of Bitcoin. This, along with the halving in this purple line, doesn't look at all like the volatility you see in monetary policy in the US and around the world. And, of course, people are in charge of it. In 1971, when the United States stopped using the gold standard and closed the gold window, monetary policy went completely crazy. Since then, it has been out of control, even though people have tried to control the effects of inflation, going too far in both directions. We think they're going too far on the downside right now. That 3% gets us to 2.5%. If inflation goes down as planned, and the Fed doesn't cut rates, the markets don't think they will, until November this line will move closer to 5%. We haven't really seen that since the 1980s, when inflation was still thought to be embedded or likely to return to double digits. Today we're not like that at all. The Fed has kept interest rates higher for longer, which means the length of time from its last rate hike to its first rate cut. This slide on the next page shows that information. We're now above normal, as you can see. You can also see that the last 3 times this happened, we were higher than we are now. This was a sign of the global financial crisis of 2008 to 2009. That was 2006 to 2007. It was an early sign of the tech and telecom bust in 1997 and 1998. And from 1969 to 1970, it was a sign of a coming decline. Just a quick note on budgeting: the shortfall is clear here. We say this every time, and we just want to stress again that the cure for this gap is an expansion of 6.5%. That hasn't really happened since the market crash of 2008 to 2009, when stimulus money was still flowing easily in response to it. Now, though, things aren't so bad. We still think growth is the answer, just like it was in the 1990s. Most of the 1990s can be seen in the Clinton government. We got back to having a balance, which was due to the very good growth. I'll say that the early 1990s were when the internet really took off. That was a big part of the growth that decade.